So good afternoon, everybody. As Ant said, my name's Matt Williams. I run a fairly new accountancy business. I used to say we're a brand new business, but we're 2 years old now, so we're kind of a toddler. And we are a fast-paced, high-growth accountancy business, and we deal really well with ambitious business owners, whether that's early stage or startup or scale up. Our business model is designed to help business owners that need a little bit more guidance from their accountant. This conversation we're having today, though, is all about the things you guys need to think about, the conversations you should be having with advisors at the early stage of a business when you're just setting up. And hopefully I'm going to be able to flick through my slides. Here we go. This is one of my favorite quotes. The best way to get started is to quit talking and begin doing, right? And so now what we're going to do is talk for the next hour. So this whole presentation is based around 3 conversations that I have with early stage businesses all the time, literally week in, week out, with a view that if you think about the conversations that we have, these 3 points, it will help you get a better idea of how to set up your business, what structures you need, etc. The first conversation is around structure. So we'll spend a little bit of time talking about the different vehicles for running a business and their tax consequences on you, the business owner, and the business itself, and the legal aspects of the different structures. We will spend a little bit of time, I promise it's only a little bit of time, on tax. So it's not a tax lecture, but it does talk about the main tax systems that affect small businesses. And then we're going to spend a little bit of time on cash flow, because that's the make or break kind of factor for every small business. So first of all, let's talk about the importance of getting the right structure. There are, in the UK, 3 main vehicles for a commercial business to operate. So we're not talking about not-for-profit and social enterprises. They have their own vehicles that they can use. We're talking about commercial for-profit businesses. And there are 3 types that you can have: sole traders, partnerships. Partnerships fall into 2 categories. They're either an unlimited partnership or a limited liability partnership. And then the third one is a company. And we're going to go through each one, and I will talk to you about what the main points you need to consider if this is the vehicle you use, and kind of play them off against each other so that you can hopefully get an idea of which one is right for you. So the first one is the simplest. This is the simplest way of running a business in the UK as a sole trader. In this case, you just need to register with HMRC as self-employed. It's the simplest vehicle for running a business in terms of admin and bureaucracy, because it is just you running a business and filing a tax return once a year with HMRC. Now, the bare minimum is that you register with HMRC. You don't even need a separate business bank account. Now, you should, and I'll talk to you in a minute about why you should have a separate business bank account, but it's not an absolute requirement. HMRC just need you to tell them what the profit is so that they can charge you the tax on it. Now, sole traders are great because they have that low level of bureaucracy and admin involved. They are cheap to run. You don't need to spend a huge amount of money on legal, accountancy, professional advice, because you can file your self-assessment return yourself. And the tax bills, whilst your profit is relatively small, so typically under 30,000 a year, the tax bills are generally lower in a sole trader than they are in the other vehicles. Now, there's caveats to this, and we'll come back to this when we talk about the tax, but in general, this is the rule. So if what you're setting up is a side hustle to a main sort of form of employment, or it's only ever going to be a modest sized enterprise, then you may think that a sole trader is the right way forwards, right? Generally, it comes with lower bills all round, but that's offset by a higher level of risk. And that's because legally, the sole trade business and you, the individual, are one and the same, which means that if your business is sued, so you provide a service and for some reason something goes wrong and someone relies on some bad advice you gave or whatever it is that you do in your business, if they sue the business, they're actually suing you. So your personal wealth, your house, your assets, whatever else you've got is kind of on the line and built into the business, even if it's got nothing to do with the day-to-day running of your business. And that's why a lot of people steer fairly clear of sole traders, because if you're running a larger business where the numbers involved are bigger, that kind of direct line between the business and your personal wealth is a significant risk, right? And once your profits get above a certain level, typically it kind of becomes between 30k and 50k. It's a toss up between whether the other vehicles or a sole trader are more tax efficient. Once you get above 50,000 of profits every year, then you're in a higher, you're paying higher rates of tax. At that point, you absolutely will be paying more tax as a sole trader than you would be through a limited company. So it's important when we think about where we want our business to be, because if you're going to go straight through to 40, 50, 60k of profits within the next 2 or 3 years, we would generally advise that you look at one of the other structures on day one. You build the business today that you want in 3 years, so that you don't have to go through a process of pivoting the structure in 2 years, 3 years time, when at that point you're also running a business that's working and moving and is busy on its own. Completely changing your structure at that point is more effort than it needs to be when you could start off in that way. So that's a sole trader. Now a partnership is effectively 2 sole traders working together into one business. So whether this is father and son, husband and wife, business partners, whatever it is, a lot of the rules and regulations around a partnership are very similar to a sole trader. So again, it's only registered with HMRC. It files its own tax return. So the partnership files a tax return based on the profits of the partnership, but then the tax is paid by the individual partners. So it flows through to their self-assessment tax returns. And we'll come back to this in a bit. Now, this is the biggest point amongst that you need to consider if you're going into a partnership with someone. And that's this point of joint and several liability. So basically, a sole trader, there's a direct line between the sole trader and their wealth and assets if they're being sued. That remains in place with a partnership, but it kind of goes on to the next level, which is you as a partner in a partnership are jointly and severally liable for your other partner's actions. So if a partnership is trading and one of the partners does something fraudulent or shady or that they shouldn't have, gives bad advice, whatever, and is sued, the other partners in the business are on the hook for exactly the same amount of money as their partner, even if they've done nothing wrong. And that's a significant point that's not always talked about in partnerships, but it puts a lot of people off of going into a partnership. Now, you can get around that by registering a limited liability partnership, but then that brings you into a lot of the extra stuff that companies do, and we'll come on to that. So because of that joint and several liability, and because you're effectively just a collection of sole traders, you still have that higher level of risk in a partnership than you do in a limited company. The positive point of partnerships, and why you'll find lots of professional firms, lawyers, accountants, etc., run as partnerships, is because it's really easy to bring a partner into a partnership and take one out of a partnership. Much easier than it is to bring a new shareholder / director into a company and then back out of a company. So if the business structure that you needs to allow other business owners in for periods of time and then let them get out again without big significant tax implications, that might be a reason why a partnership is the route for you to go. And then the third option, and this is pretty much the most common way in terms of businesses that we look after, 95% of them, so we look after about 250 businesses, 95% of them are limited companies. So limited companies are separate legal entities that are registered with Companies House, right? So you'll notice there's some businesses you'll see on their branding has the word LTD or limited at the end of it. That's because it's a formally registered company with Companies House. It's a separate legal entity to the owners of the business. It's its own thing, has its own bank account, its own money, its own legal affairs, etc. And it's owned by its shareholders and run by its directors. So typically a small company is, I don't know, has 100 £1 shares, right? And then those 100 shares could be owned by one person. They could be owned by 100 individual people. Typically it's owned by two people, husband and wife, say, that own 50% of the company each. The shareholders own the business, and then you have this other concept of directors, which are often one and the same in owner-managed businesses, but don't have to be. Directors run the business on behalf of the shareholders. So in a typical small business, they're all one and the same, so it doesn't matter. But if you go to bigger businesses, let's pick, I don't know, Amazon. Amazon has a board of directors who run the business on behalf of the thousands upon thousands of shareholders that own shares in Amazon. As I said earlier, it's a separate legal entity, a company, and this gives you the two things. It gives you increased regulation because it's a separate legal entity. It has to file its own things. It has to file more complicated accounts with Companies House that are on the public record. It has to file its own corporation tax return, has to do other compliance statements every year to make sure that it's operating as it should. But the benefit of that is that it gives the directors and shareholders much lower levels of risk. So if someone is suing your company, then whilst they can sue and win and take the money out of the company that it may have, it can't get past the company to the wealth of the shareholders. And that's a really important point. And that's why typically larger businesses almost always run as limited companies, because that gives them that ability to separate personal wealth to company wealth and lowers the risk overall. And typically they are more tax efficient once your profits are above that sort of 40 to 50k. Certainly above 50k, they're always more tax efficient. And that's because the rate of corporation tax that the company pays is less than the rate of income tax that individuals and partners pay. And we'll come back to that. So these are our three types of businesses. Sole traders, these are really good for micro businesses. They've got less levels of compliance relative to a company, but the way sole traders are taxed, their income is from the sole trade is added on to all other types of income they have. So if you have a full-time job and you're running your business as a side hustle, if your full-time job is paying you 40,000 a year, you need to be careful that your £15,000 of sole trader profit that you may make on your side hustle is going to get added to that 40, which may then take you above into the higher rates of tax. So you just need to factor in everything when you're looking at that 30k cutoff, where it's better to be in a sole trader, only works if you don't have any other sources of income. And if you do, then you need to speak to an accountant, and they will be able to give you an idea as to whether you want to just go straight into a company to make the whole tax position neater. Partnerships, these are good for any business that's got a changing business ownership. So if you're bringing partners in, taking partners out, it's much easier. Again, you're under the same tax regime as sole traders, so you need to be aware that the profits that you're making as an individual partner are being added to any other income you have, and may then take you over 50k and make it more tax efficient to be in a company. And then you need to factor in this point of joint and several liability. So do not go into partnership with someone that you're not 100% sure with, because you're on the hook for their bad decisions as much as they're on the hook for yours. And then finally, we have companies, which are great for businesses that are on a curve to exceed that £50,000 of profit. If within your 3-year plan profit levels are more than 50,000, generally the advice would be to set up as a company on day one. But they do have increased bureaucracy, increased compliance, and they do give you that limited liability that you don't have from the other two forms of business. Okay, I feel like I've rattled through that. Has anyone got any questions on that? I can't see the chat box to see if anyone's asking questions. How are we doing? Are we
Yes,
okay?
there's one question that's definitely relevant for this point. In terms of registering as a sole trader with HMRC, do they do that? Do they have to do that straight away as soon as they decide they're starting a business, or only when they start selling stuff, or when they start making a profit?
That's a cracking question. So HMRC's, if you look on hmrc.gov.uk, they will tell you need to register a sole trade within 3 months of starting the business. Now, their definition of starting the business is earning money. So creating an invoice, selling something, making them, making the profit on it. Now, that's the kind of company advice, if that makes sense, from HMRC. In reality, you need to register within the tax year that you start to trade. So and the tax year runs from 6th of April to 5th of April. So if you started in September, as long as you've registered by the following 5th of April, then you're okay. And registering and filing the tax return doesn't necessarily mean that you'll be paying tax, because you don't pay income tax on the first £1,500 of sole trader profit anyway, irrelevant of how it fits into the rest of your income. So there's a disconnect between registering and actually paying tax. But if you're in doubt, you're better off to register, not least because HMRC's systems are broken at the moment, and it could take you 3, 4, 5, 6 months for them to actually formally register you as a sole trader. That won't affect you trading, but it does mean that you want to get the process sorted as early as possible, because the risk is that it sits there on one of their desks for months on end without moving.
Okay,
cool.
Thanks. And then just one more. Can a sole trader protect themselves with professional indemnity insurance?
Yes, they can. Absolutely, they can. But that doesn't. If for some reason the insurance doesn't pay out, it doesn't give them the protection that a company does. So yes, you can insure against it, but if something does go terribly wrong, there is still that direct line between a law case on the business and your personal wealth, and you can't get around that as a sole trader.
Okay, thanks. Back to you then, Matt.
Brilliant. This is the fun bit now. We're going to talk about tax. I will go through this as not as quickly as I can, but as succinctly as I can to give you a flavour, because basically, as a business owner in the UK, you're likely to encounter 4 main taxes. Each of these is taxed individually on a different return, has different payment dates, different reporting dates. Some you won't encounter for a little while, some you will take on day one. It just depends on how you structure the business and kind of what activity levels you've got on day one. So we're going to go through them all fairly straightforwardly, hopefully. So the first one is income tax. So this is what every individual in the UK pays. So this catches sole traders and partners in partnerships. So income tax, as I said, it's paid by individuals and sole traders on all of their UK taxable income. So your taxable income as an individual taxpayer could be employment income from a job, dividend income, which is basically the profits being distributed out of a company that you may have shares in. You may have a buy-to-let property, so you have some property income. And then the sole trade profits and partnership profits if you set up your business that way. All of those get added all together, and then you report them on a personal tax return every year. Now, each individual in the UK has allowances. So this is the amount of money you can earn from all of those different areas of income, how much you can earn and what the tax rates are. And this is subject to obviously the budget every year and the Chancellor changing and tweaking them. But at present, you can earn £12,500 of total income from anywhere and not pay any tax on it at all. Then the next chunk up to the £50,000 higher rate threshold is at 20%, and then up to that is at 40% and beyond. If you're a sole trader, you also pay national insurance on your profits at 9% once you hit a threshold. All of that's done on a tax return that's filed once a year, it's a self-assessment return, so you can file it yourself as an individual. Lots of people use accountants to do it because it's a form with about 400 boxes on it, and typically you may only need to fill in 15 or 20 of them, but knowing which 15 or 20 to fill in is the trick, right? And that's why people just hand it over to accountants and let them do it. The personal tax year in the UK runs from the 6th of April to the 5th of April. So we are just at the start of the 21-22 tax year, so which runs to the end of the 5th of April 22. And then tax returns for this year, this financial year, so running to 5th of April 22, needs to be filed and the tax paid by the 31st of January 2023. So it's a big old, long old process. You can obviously file your tax returns any day you want after the 6th of April, so the first day of the new tax year, but the tax isn't payable for 9 months. Separate to that, as I said earlier, companies are their own separate legal entity. They don't pay income tax because they're not individuals. They pay corporation tax. So this is only paid by limited companies, and it's a flat 19%. So there's no personal allowances, there's no changes in bands. At present, as we sit today, all profits made in a company are taxed at 19%. So if we just go back a few slides, you can see if you're at that 40k, say, of profit, you are paying a big chunk of, as a sole trader, sorry, you'd be paying a big chunk of your profit at 20% plus 9% national insurance on top. So a 40k level of profit, anything over the 12.5 personal allowance, you're paying at 29%. Whereas in a company, you're paying a flat 19%. So that's where the tax efficiency of a company starts to kick in. Company tax returns are tied to the company's tax year end. So each company, if you set up a company today, you'd be given a 30th of June year end because it's the month in which you incorporate drives your year end. And then your corporation tax return is always going to then be reporting to the 30th of June each year. So you then have 12 months from the year end to file the tax return. So if you set up a company today, your first year end would be June 22. Your first corporation tax return would be for that period, but needs to be filed by June 23. And then just to make it more complicated than it needs to be, whilst they give you 12 months to file the corporation tax return, they give you 9 months and 1 day to pay the corporation tax. So you pay the tax on your June 22 profits in March, or 1st of April it would be 23, before you've even filed the tax return. Don't ask me why they do that. It's just typical HMRC. Someone had a light bulb moment and didn't think about all the consequences. But again, it has its own tax affairs that are completely separate to the individuals that own the business, which means that if you run a company, you're going to need to keep track of different sets of reporting dates, the company's own dates and its accounts and tax returns and tax payments, and then you, the individual, who still needs to file your personal tax return to the 5th of April / 31st of January dates that all individuals need to adhere to. The third tax, and this is the one that a lot of businesses are not caught out by, but this needs a little bit of thought if you're about to become an employer. So whether you're a sole trader, partnership, or limited company, if you're taking on an employee, so you're paying a worker who is not a part of the business ownership structure, so a third party, then you need to register for what's called PAYE, so pay as you earn. And then you, as the employer, deduct that individual's tax and national insurance contributions from their salary every month, and you're effectively a tax collector. So you'd have all, hopefully, I assume, had pay slips from employers in the past. You would have seen that you're deducted the tax and the national insurance. Your employer at the time has to add all that together for all of their employees and then pay it over to HMRC every month. And you have to follow the tax codes that HMRC give each individual, which basically means that then the majority of the UK population don't need to file tax returns because all of their tax affairs are dealt with through PAYE. So the the tax code is basically a way of HMRC getting that person's taxable allowance, the 12,500 tax-free, into their tax affairs, so that they don't need to file a tax return at the end of the year. So these are what you deduct. You deduct income tax, you deduct employees NI. The bit that catches out a lot of new employers is this concept of employers' national insurance. So as an employee, you get deducted PAYE tax. You also get deducted employees' national insurance. Unbeknownst to you, because it doesn't appear on your payslip, your employer has always paid 13.8% employers' national insurance on top of your salary over to HMRC. So as an employer, you need to factor in that if you're paying someone 20,000 a year as a salary, you also have to factor in employers' national insurance, which is 13.8% on top. Now, small employers can claim the first £3,000 of employers' NI back every year. So if you're only employing 1 or 2 people, it won't actually affect you unless they're on significant salaries. But as your headcount grows, your PAYE bill grows, employers' NI is a kind of a hidden cost that a lot of people don't realise is there when they set up a business. You also become the collector of student loans and potentially child maintenance. So there's a lot of admin in PAYE, and you have to file returns with HMRC every month. So you need to, you have to use software. The software does all the heavy lifting in terms of running all the calculations, but you need to be set up to do this kind of monthly admin run of setting all the pay slips up, putting all the numbers in, deducting the right amount of tax, paying that over, filing the right forms. You also, after the first few months, have to set up an auto enrollment pension scheme. And again, whilst you deduct 2 or 3% of their salary from your employees for their contributions, you as the employer have to then pay 3% on top. So again, included with this employer's NI, which is 13.8% on top of your salary, you've also got this 3% pension. So it adds up quite quickly, all the extra bits and bobs around paying people. Obviously, the benefit to you is that your business really is only going to grow with other people in it, right? As soon as you've got a team of people earning money when you're not there, then that's the dream position for every business owner. So that's PAYE. Typically, again, that's a job that most business owners hand over to a bookkeeper or an accountant, because it's a thankless task, right? Everyone checks their pay slips. So if you get anything wrong, you get it in the neck straight away. It's a lot of bureaucracy and admin involved. Just chuck it off to someone. Someone will charge you. It's a few pounds a pay slip for someone to provide you the payroll service, and it just takes all the stress out of it for you. And then this is the fun one. So VAT. So this is a tax. Of all the taxes that you'll encounter as a business owner, this is the one that HMRC do not mess around with. So every other tax, and maybe I shouldn't be telling you this as an accountant, but every other tax, you have some leeway with HMRC. They are, to some extent, on your side. Everything's self-assessment. If you get something wrong, they'll help you fix it. If you can't pay the tax bill on time, they'll help you make payments, bring a time to pay agreement in so that you can spread it over a few months. VAT is not quite like that. And that's because you're effectively collecting tax for HMRC, and they want you to view it that it's never your money in the first place. And it comes back to, there's 2 types of VAT. There's what's called output VAT and there's what's called input VAT. So I'm an accountant, I run a business, I'm VAT registered. So every time I charge a client, let's say £100 a month to look after their accounts, for every £100 that I charge them, which is my bill, I have to add £20 VAT on top, 20% VAT on top of my £100. So my customer pays me £120, but that 20, the VAT is never my money. It doesn't come into my profit and loss account as revenue for me. It is purely my job as a tax collector for HMRC. So if you take one thing away from this talk, if you end up as a VAT registered business, and we'll talk about when you need to register in a minute, if you register for VAT, get into the habit of squirreling away 20% of everything your customers pay you and putting it into a separate VAT bank account. And that way you'll never end up in a situation where lots and lots of businesses do, where they end up with a quarterly VAT bill and they don't have the money because they didn't realize it wasn't theirs to start with and they spent it. And that is the absolute worst place you want to be. But on to happier things. So you charge output VAT on your sales, you recover input VAT on your costs. So all of my clients who use me as an accountant, I charge them my £20 VAT on my monthly fee. They recover that against the VAT that they charge their customers. So to keep with me as the example, I charge all my customers X amount per month plus 20% VAT. So let's say I collect from my customers £5,000 in VAT this month. I then look at all the costs that I've incurred in terms of, I don't know, software that's got VAT on it and my rent for my office and all the utilities and the phone bills. All of these costs have VAT on them. I recover that VAT against my 5,000. So let's say I've incurred £1,000 worth of VAT on all of my costs. At the end of the month, I knock the £1,000 of input VAT I've recovered off of the £5,000 of output VAT I've charged my customers, and I pay the difference, the £4,000, over to HMRC. That's how the VAT system works. But the big overriding principle in all of that is that the VAT you're charging your customers is never your money, and don't get into the habit of spending it. And also, unless you've registered for VAT, so unless your turnover has gone over 85,000 in a year, in which case you're compelled to register for VAT, or if you've taken advice and you've been advised to register for VAT early, which lots of businesses do, particularly if you're a business to business business, because if your customer is likely to be VAT registered, you charging VAT on top of your prices is not affecting them at all, because they can recover that input VAT. If you're selling directly to consumers, so let's say you're a hairdresser, you charging VAT to your customers is just making you 20% more expensive than you need to be. Does that make sense? Because your individual customers can't recover the VAT that they're spending. So if you're business to business, often you'll register for VAT earlier than you need to. If you're business to consumer, typically you would wait until you're compelled to at 85,000. What you cannot do, and lots of businesses fall foul of this, is see that everyone else is charging VAT on their products. So you, without registering for VAT with HMRC, you just start charging VAT on your invoices. If you do that, technically that's fraud. HMRC take a very dim view of that. So don't mention VAT on your invoices unless you've got a VAT number from HMRC. And then there are, because VAT is the one tax that lots of business owners fall foul of, there are various schemes there to simplify it for small businesses. Again, a good accountant will be able to talk you through all of those schemes and kind of help you get onto the right one for your business, because some of them are particularly good for certain types of businesses, etc. So that's my whistle-stop tour of tax. Hopefully you're still awake. Have we got any questions, Ant, that we want to talk about?
So there's one or two questions that take us back to HMRC, but I'll save those to the end, Lorna. So a question here about VAT, and I know the answer, but I'll let you answer it. So if your input VAT is higher than your output VAT, can you claim the money back from HMRC or avoid paying it in the first place?
Yes, you can. Now, typically, first VAT returns are often a repayment from HMRC. So if imagine, I don't know, a tradesman setting up an electrician's business. To get going, he may buy a van and a load of tools and set up a website, all of which would have VAT on. It may well be that at the early stages, you've just recovered more input VAT than you're charging your customers. HMRC, the first time you're due a repayment, will check the return, because it's really easy to just defraud HMRC otherwise, right? So they come and they'll check that, you know, the 5 biggest invoices to make sure that you have bought the van that you've said you have. But yeah, the process is straightforward, and some businesses flip between repayments and payments quarter to quarter. Specifically, people in the food industry, so farmers, they recover a load of VAT on all their costs of kind of running the farm, but actually if they sell crops from the ground, there's no VAT on it. It's 0% VAT. So they're always recovering VAT. But yes, in essence, you can recover VAT.
And I guess, given your explanation there, then Matt, that's why some businesses might register early, because you've got a lot of spend. There's going to be a lot of VAT that you can recover.
Absolutely. So, for example, I know one of the Ran right at the start said he's launching an app. So, Ran, if you've got lots of costs from coders and developers and marketeers or whatever setting up that product at the start, you may want to register for VAT, because you can go back 6 months and recover VAT that you've already paid as well. So the day you register, you can then look back at the last 6 months of costs that you've incurred and harvest that VAT. Obviously, you need to take advice on that, because if your product is going to consumer, the knock-on effect of being 20% more expensive to your consumer may outweigh that benefit of the VAT. But in theory,
do that at the end of when you report for HMRC, does it have to be within the first 6 months?
So you register, let's say you register with HMRC today.
Yeah.
Once they've given you the VAT number, you can then go back a set period of time, 6 months for services, 12 months for product, and recover the VAT.
Okay, cool.
Excellent. So over to your final session then, Matt.
Did you say there were some other questions about HMRC? Did you want to do those now?
Yeah, I can do. Okay, so Lorna, as a sole trader who started in November 2020, currently making a loss, should she have registered with HMRC before April this year?
Technically, yes. The result of it is, if you register now, you're not going to, there's no penalties or anything like that. And if you've got other income, potentially you want to get that loss registered. So file a return with the loss on it, because you can potentially offset it against other taxable income and maybe get a tax refund if you've got a job that you're working on at the same time.
And I think you've answered the second question by default there. So yeah, if you've got the two incomes and a loss in your business startup, that can reduce your overall tax. Not
always, but often. It's never, every question about tax has got an "it depends" answer, unfortunately. Yeah. But yes, in theory, you can move. Losses are really useful for us as accountants for tax planning, because you can carry them back sideways, relief them against other income, or carry them forward against future profits. And the trick is to understand which gives you the best bang for your buck, really.
Yeah. And it's your self-assessment that would work all of that out.
Absolutely.
Yeah. And I would echo what you said. So I used to do my own self-assessment myself for several years. 2 years ago, I ran out of time. I asked my accountant to do it for me, and I got a lovely rebate because I'd been doing it quite wrong.
It's amazing. HMRC won't come to you and say, "Oh, by the way, it looks like you paid too much tax." Doesn't happen. They'll come the other way if they think you've underpaid. So yeah, typically a good accountant will save you more than their fee in perfectly legitimate tax breaks, not anything dodgy. You won't be on the 6 o'clock news for tax evasion or anything like that. Okay, right, let's move on then. So we've done structure, we've done tax. Let's talk about cash flow, because this is the bit that's going to basically make or break your business. Whatever you do, whatever you sell, however you sell it, cash flow is what keeps businesses alive, right? It's oxygen to your business. And you need to, the trick or the trap that lots of business owners fall into is that they look at a profit and loss account. So how much sales they've made compared with costs they've had, and look at that and assume that everything's fine because you've made more sales than you've paid out in costs. And that might sound like I'm talking nonsense, right? That obviously that's a positive, but depending on how the cash flow moves through your business, you can have a business that is profitable but cash poor. And plenty of businesses have fallen over because they ran out of cash. They very rarely fall over because they're not making a profit. And getting those two concepts in your mind, that just because you've made a sale, if your customers pay you on 30-day terms, like mine do, I can make all the sales in the world. If my customers don't pay me, I may be able to show a profit at the end of the month. But if it's sat in other people's bank accounts, it's at risk for my business. Hopefully that makes sense. So 5 simple conversations we have with business owners on day one to help them improve their cash flow. Some of these sound really simple, but you'd be surprised how many people don't follow this. So job one, bill on time, every time, right? That sounds obvious, but what I mean by this is you're never more likely to be paid than the moments after you've delivered the service. So if you're a plumber, you want to be billing your customer while you're sat on the driveway programming your sat nav to your next job, right? Get the bill in their hands because it's top of their mind. They're happy with what you've done. You're more likely to get paid quickly. We had a conversation the other day with another accountant, would you believe, had realized that they hadn't billed one of their clients for 6 years, and they sent them a bill for a phenomenal amount of money. We're really sorry. We've just noticed that we haven't billed you for 6 years. Here's a bill for north of £10,000 and here's 14 days to pay it. The likelihood of them getting that £10,000 paid is very remote, I would say, because you know it's too far removed from the point where they delivered the service. So if you get anything right at all in your cash flow, it needs to happen when you bill the day you do the product. If you're a shop and you can bill them at the point where they give you the money, obviously that's even better. But bill on time, every time. And the best way to bill on time every time is to use technology. Use Xero or QuickBooks or Sage or Free Agent or any of the online cloud-based accountancy packages. All of those will allow you to create your sales invoice within the system and then email it directly to your customers. And if you do that properly, let's take Xero as an example. You use Xero to create your sales invoices. You email it to your customer. Xero will tell you when they've opened that invoice. So you can't have people saying, oh, sorry, I didn't get your invoice. Can you send it again 60 days later? You know that they've seen it and you know that they've opened it. If you take it on to the next level, we use two bits of technology in our business. So most of our clients pay us on a monthly fee. So we use a tool called Go Cardless, which creates direct debit mandates. So all of my customers, they pay me on direct debit that the technology sorts out. It costs us a couple of pounds a month per customer. But we create an invoice today. I know within 14 days it's being deducted from my clients' bank accounts by direct debit. Nice and straightforward. I don't have any cash flow issues because it just gets paid. For the one-off stuff that isn't on a direct debit, we use a system called Stripe, which is a credit card payment gateway. All of our invoices have got a big green button on, and you pay us by this generally. You click a green button on our invoice, put your card details in, and we get paid the same day. Again, what we're trying to do is use technology to make it as easy as possible for our customers to pay us. Because if you're difficult, if you don't put your bank details on your invoices and they have to ring you or email you to get them, it puts you to the bottom of the list of people they're going to pay. Number 3, consider your payment terms, right? So depending on what you do, it may be industry standard to get paid at the point of delivery. It may be industry standard to get paid after 30 days of giving them the invoice. You may be selling, I don't know, product to big supermarket chains where it's industry standard to be 60 plus days, right? Understanding what your terms are, how long you want to give your customers to pay you has a massive impact on your cash flow. We have a kitchen manufacturing business, right? The average price of his kitchen is about £30,000, and his payment terms were always 30% on the point that you order, because that's how much it costs him. He has to then spend out on timber, about 30%. So he got his timber cost covered, and then he paid the balance at the point where he'd finished the job and the kitchen was fitted, which meant that on a job where something went a little bit, got delay, you know, they were waiting for an electrician to come in or they couldn't get the right door handles, he may have work that he'd 99% finished but couldn't invoice because of someone else's issue. And that was having a massive impact on his business, on his cash flow. So we sat and we discussed this with him and we tweaked it to something. It feels obvious now we look back on it, but he'd spent his business for 7 years running on this other way. So he now charges 30% up front, and then he charges a further 50% at the point where he delivers the kitchen to site. And then the balance, the final 20%, gets billed once he's finished and had it signed on. And what that did was sped up, on average, £12,000 per project. It sped up the cash coming in by about 40 days. And once you factor that in on, you know, he does 5 kitchens a month, that's the difference. That's 50 odd thousand extra in his account at the end of every month, just from tweaking his terms. So the best time to do this is before you start billing people, because then it just becomes the norm. And don't be afraid to put terms in place and then stick to them. And if that is 50% up front, don't let people get away with it. They'll either want your service and they'll pay it, or they don't. And if they don't want it, that should be a red flag as to, if they weren't going to pay the 50% up front, they probably were going to be difficult to pay the 100% at the end. So just, you know, stick to your guns and don't be worried about having a conversation about your terms on day one. Similarly, don't be afraid to chase the money, right? If you've provided the service, it's your money, and that's the mindset that you need to have, and that it's no good to you while it's sat in someone else's bank account. And this has a particular impact once you're VAT registered, because typically if you bill someone and it's got VAT involved, if you've not been paid for that bill, you still have to report and pay over the VAT to HMRC unless you go onto one of their schemes. So you could be in a position where you've paid out the VAT on the job that you've billed, but you haven't recovered it yet. So suddenly you're out of pocket by 20% rather than just waiting for their bill to land in your account. So the best advice we give to people that are on terms and are needing to chase debts is send your invoice electronically, and then before it's due, so let's say you're on 30 days terms, the week before it's due to be paid, ring them up and just checking that you've got my invoice. I'm just wondering, is it on the payment run for next week? Nice and polite before it's due will almost certainly get you onto the list and get you paid. Most small businesses don't like to be seen to be tardy payers, right? So most people will just pay you, but it will be certain people every month that are difficult. Make it easy for them and be persistent, and you'll get paid more often than not. But just have that mentality that it's no use to you if it's in their bank account. And then finally, every good business has a cash flow forecast. So this is, it doesn't need to look too far ahead, maybe 12, 18 weeks, but you understand what direct debits are coming out of your business bank account every week. You understand what work you're doing and when you should be paid, and you understand what costs you've got and when they need to be paid. If you plot them into a forecast template, and we can let you have this, you know, we've got one built that we send to our clients, understanding when these people pay, when these costs are going out, what that does to the bank balance. Not only does it let you plan if there's an issue, so you know that you need to find another £2,000 from somewhere by billing this job earlier than that one or whatever. It allows you to plan, but more importantly, it takes away the stress, because as a new business owner, almost all of your stress is going to be around cash flow. And you'd be amazed at how just putting it into a spreadsheet and understanding that it's okay to be spending more than we need to, or spending more than we're generating this month, because next month it turns around and we start getting paid by the customers. Understanding that and putting it on paper actually takes so much background stress away from business owners. It's just unreal. So if you do anything at all, get a robust cash flow forecast. And then once you've set it up, I have one in my business still 2 years in, and we just refresh it every 6 weeks. We add 6 weeks onto the end and move it along. And that's kind of the biggest takeaway we've got on cash. Bill on time, use technology to bill properly, look at your payment terms before you get going, because that's the easiest time to change them. Don't be afraid to chase debts, and then forecast your cash flow. And then I will leave you with this slide, which is a nice picture of some skyscrapers, but the point to take away from here is every big business that you look at today, let's take Uber, for example, which is now a household brand. While it's being built, when all the stress and all the hard work is going on, nobody knows about it. It's like building a skyscraper in London, right? for the first 40 stories, most of the people can't see what you're doing or what's going on. It's only once you build, you know, the 51st floor and you appear up here that people actually see what you're doing. All of the hard work is, as we're building a skyscraper, is with a business, is at the foundation level, right? You're going to do a load of work and no one's going to see where you are until you get to the end. The moral of the story is everybody who's got one of these big skyscraper businesses is where you were at some point in the sort of not too distant past, more than likely. And that's me. You can email me if you want more of this sort of stuff. There you go, Ant. Anything else we need to talk about?
Fantastic. Thanks, Matt. There's a few questions. Yep. So you mentioned a number of different technologies there, free agent, Sage, Zero, etc. What about the free ones, such as Wave? Are they okay, or do we need to go for a paid one?
So I subscribe to the philosophy that you build the business today that you want in 3 years. So if Wave is fine for where you're going to be in 3 years' time, then yes, 100% use it now. I've got a Curry networking business, and whilst my business is affiliated to Zero and all we talk to our clients about is going on to Zero, my Curry business is only ever going to turn over about £1,500 a year. We put it on Wave because it would save us £10 a month. So the free ones are okay. There's a reason they're free, like with anything in life, right? There's a reason it's free. It's good enough, but what you wouldn't want to do is go on it for 2 years and then move on to one of the paid ones, because the process of moving is going to be more effort than just setting up and stomaching the cost on day one.
Yeah. Okay.
So that's point one. What else have we got, Ant?
So can you automate? So do any of these software things automate generating your cash flow forecast?
None of them automate it for free. There are lots of cash flow tools that you can add on to QuickBooks and Zero and Free Agent, but they're going to cost you an extra fee a month. And genuinely, unless your business is starting day one with a significant cash flow kind of activity, I like the idea of business owners using Excel and understanding their numbers, because they're typing them in and they're thinking about them and they're not just letting some software predict it. So
yeah,
if you do it by hand, you'll get more out of the process. Now, down the line, absolutely, we want to automate as much as we can in your finance function. But for the first 6 months, having it done by manual processes is going to give you a better foundation of your numbers.
Brilliant. Thank you. Slightly different tack here. So directors' loans. So if we're in a limited company and a director's got a loan, the process around it and how to pay the loan back.
Okay. So a director's loan is, in essence, an amount of money that the company owes the director / shareholder. So it comes back to that concept of a company being a separate legal entity and having its own money. So if you've got a director's loan, which is typical for small companies because the directors are the source of funds to get it off the ground and running, you can, at any point that there is cash available, withdraw that director's loan or an element of it. So let's say it's 30 grand, you could take £1,000 here and there, or 30,000 in one go, depending on cash. And it has no tax implication at all on either the company or you, the individual. Typically, if the company is generating cash, it's making a profit, and therefore a good accountant would talk to you about, don't just because it's tax free, don't just draw all the loan account out. Let's mix it in with a remuneration plan around dividends and salary to give you the most tax efficient long-term view. But if you've got a loan and the company has cash, it can pay you the loan back without any tax implications.
Do you need any paperwork for that, Matt?
Not if it's a loan that way round. So if it's a loan where the company owes the director money, it's fine. If the director has taken out more money than they should and technically then owes the company money, so the loan is the other way round, then you need to take advice on that, and you would need some paperwork. Okay. If you've got third party shareholders, so it's not just you that owns the shares, you may want some shareholders agreements or something in place to set out how and when the loan would be repaid. Because what you don't want to do is one director loan 50,000, the other loan 10, and then you fighting over who gets paid back what and when. So if it's just your business, Ran, you're okay because you can do what you want with no.
Going back to PAYE and paying wages and stuff like that, you mentioned quickly about dividends and stuff like that. Do you have to pay a wage to a director or someone who's a shareholder?
No, it's generally tax efficient too. So generally, if a business is making 50, 60K a year as a company, typically the director would take a 10,000 or less salary, normally somewhere between £8,500 and £10,000 as a director's salary, which basically gets them up to their personal allowance. So there's no PAYE tax and there's no national insurance for them as an individual. The company can deduct that £10,000 salary from its profits on which it pays corporation tax. So we pay no tax as an individual and save, let's say, £1,900 of corporation tax. And then the balance comes out as dividend, which is taxed at 7.5%. That's a typical director's remuneration. It changes and is different for every company. But that's exactly the sort of conversation a good accountant would be having with you.
Mm. But you have to register to give dividends.
Not dividends, just salary. And also, if you're developing, one thing I didn't talk about, and I meant to when I saw what you were doing, Ran, if you're developing tech, you want to be a company because you could potentially recover R&D tax relief. And if you're actively involved in developing the tech, your salary will govern how much R&D tax relief you can have. So
yeah, it's a limited company.
But you do need to register for PAYE before you can pay salaries out.
Yeah, cool. Cheers for that. It was really good. Thank you.
So thank you very much again, Matt. Really, really useful. I enjoyed that. I think everybody else did. And yeah, so we'll see you again in a couple of months for the next.
Absolutely. If anyone wants, not free advice, because I can't give free advice, I'm not insured to do that. If anyone wants to follow this up, if you find me on LinkedIn, I'm all over LinkedIn. Hit me up and message me on that and we can have another chat.
Brilliant.
There we go.
Everyone. Take care. Goodbye.
Bye.